Why hasn't the market crashed yet? I'm sick and tired of waiting. Interest rates are basically staying around 6.8 to 7%. It's expected the feds are going to raise interest rates probably a couple more times this year. Meanwhile, housing sales remain relatively flat for the month of May, rising only 0.2% according to the National Association of Realtors. Where the hell is this big crash that everybody's been telling us will come? There are so many people right now that want to buy a home, and these prices are just too freaking high. While experts aren't predicting that we're going to have an overall market crash at this point, opinions really differ from what's really going to happen next. Some forecasts have the housing markets falling, while others are predicting that it'll go up. Who's right and who do we believe? The University of California, San Diego predicts that housing prices are going to drop about 5% nationally, while in some cities it can drop as much as 18%. CoreLogic, a real estate data provider, expects that national prices will head in the opposite direction, notching a 3% jump by the end of December. Without a clear direction of what's really going to happen, everybody is basically just biting their nails and waiting. And waiting, and waiting, and waiting. Now this is gonna be kind of a long video, so as a bonus for watching the whole thing, here's a video of me playing with my really cute dog. What does the current real estate home sales look like right now? Well, it really kind of depends on what part of the country you're living in. Cities like Bellingham, Washington, according to CoreLogic, is a very high risk area and expected to see high price declines. Same is true for areas like Destin, Florida, Salem, New Oregon, Merced, California, and Honolulu, Hawaii. At the same time, the supply of homes is at an all-time low. According to the National Association of Realtors, NAR, the total inventory for 2023 is the lowest it's been since 1983. The sad truth is that there are more real estate agents currently than there are homes for sale nationally. This means there are a lot of real estate agents going hungry. And with the reduced supply, home prices will probably not drop substantially for the foreseeable future. Look at this. Millennials are the largest population in the country, surpassing the baby boomers. Now the baby boomers currently hold all the wealth in the United States, but they won't be around forever. And as baby boomers continue to decline, will there be enough of an appetite from the millennials to absorb all of this excess inventory? Yeah, probably. Plus, the kids of these baby boomers will probably inherit their homes. So we're gonna see a little bit more shortening of inventory for quite a while. According to the US Census Bureau, boomers have remained the second largest population group in 2022, comprising of about 86 million people and starting to drop. Also, Gen Zs aren't old enough to afford to buy homes, but in the next 10 years, they're gonna be entering the housing market as well. And the Generation X will start to decline in population. If no new homes are built, there's going to be a shortage. According to this article from CNN written on March 8, 2023, the US housing market is already short 6.5 million homes. So even if home builders immediately started building and adding 100,000 homes per year in the United States, it would still take us 65 years to meet the housing demands currently that we're facing. This brings us to the question posed in the title of this video. Is this going to collapse the housing market? Anything is technically possible, but it's not going to be for a while, and here's the reason why. Chances are anyone who is currently waiting is going to continue to have to wait longer. Until the supply of housing catches up with the demand from the buyers, there will always be a shortage. We expected a decline in the housing prices during the pandemic, but instead of seeing a decline, we actually saw prices skyrocketing. This was primarily due to the Feds dropping interest rates to nearly zero. When mortgage rates were below 3%, either people purchased new properties or refinanced their home. And as a result, these people had locked in their home, and now they're having a very difficult time to sell because they don't want to trade it for another property at a higher interest rate. It wasn't until the Fed started increasing rates that the housing prices declined. When mortgage rates went from 2.5% to 7.5%, the market took a really sharp turn. Locally here in San Diego, for example, we saw a price drop of more than 10%. We now see that prices are starting to level off and even increase modestly in certain areas. It's simple. Higher interest rates basically means that people can afford less home. Their monthly payments would now nearly double, which lowers the amount they can qualify for. And in the short term, we will see some adjustments in the housing prices, but long term, I think prices will continue to go higher and higher. Another part of this is the monthly supply of inventory. Most professionals will agree that if we have around a 6-month supply of inventory, we're in a buyer's market, meaning there is more supply in the market that can be absorbed, so buyers are going to get a good deal on their home and prices will drop. If the supply is less than 6 months, this will favor the seller. Just look at these charts from Realtor.com and you'll see that the number of homes listed for sale in June of 2023 is nearly half compared to the previous years. When you look at the number of listings that went pending, meaning the seller put it on the market and the buyers were there to purchase it, the numbers also went down. This makes sense. There are less people putting their homes on the market for sale because they're locked in at their 3% interest rates. And there are less buyers that can afford to buy a home because the interest rates are at 7%. When you look at the regional statistics for June of 2023, you'll see that the number of new and active listings has dropped by more than double digits, while the median listing prices have gone up. Yet even with the higher listing price, the median days on market, meaning how long it takes for the home to sell, is between 6 to 15 days. So what can cause a market to crash? Well, the biggest thing is unemployment rate in the US. If people don't have jobs and they can't make enough money, this can cause a big problem in the economy. People will spend less if they make less, and this could cause a big correction in the housing market. If this happens, people will be struggling with more than just housing. They are going to be struggling and trying to figure out how to put food on the table. The good news is our current unemployment rate is only at 3.6%. The rate is not dramatically different from the unemployment in 2022. If unemployment starts going up to like 6 or 7%, this can cause a big strain on our economy. Another thing that can cause an economic crash is inflation running out of control. As prices rise, people can afford less and less goods. You've seen the price at the pump, right? I mean, how much have you paid for gas lately? It's gone up over the last couple of years. Some items like beef and eggs have gone up a staggering 30%. This is why the Fed started raising interest rates. They were concerned that inflation would run out of control. Just take a look at Venezuela. They've seen inflation go up 300% over the last year. This is just insane. Imagine the cost of food that you buy going up 3 times. That means a carton of eggs that started at $4 is now going to cost you $12. If you take a look at these two charts in June of 2022, inflation was at around 8.52%, and now inflation is down to 2.97%. The Fed chair said that he wanted to bring inflation down to about 2%. So we're almost there. Why is consumer confidence important to the economy and to the housing market? Well, consumer confidence is defined as the degree of optimism about the state of the economy by the consumer, like you and me. And they're expressed by activities in either spending and savings. So the more confident a consumer is about the economy, the more they're willing to spend, therefore stimulating the economy for all of us. If consumer confidence, however, is low, people will begin to save more and spend less. This will cause the economy to completely retract. The consumer confidence actually rose in July of 2023 to the highest level it's been since July of 2021, reflecting a pop in both the current condition and the expectations, according to Dana Peterson, the chief economist at the Conference Board. The Conference Board also showed that the consumer confidence hit 117 in July, rising from 110 the month before. The index increased for the 3rd consecutive month, bounding even higher after a sharp swing upward in June. You'll notice that there is a huge drop from 2007 to 2009 and another drop in 2020 due to the pandemic. The expectation is that the consumer confidence will continue to rise, albeit modestly. The strong labor market and cooling inflation will help keep Americans upbeat about both the current and near-term prospect of the economy, according to the report. This brings us to the Consumer Price Index, or CPI. It measures the overall change in consumer prices over time based on the goods and services. It tells us how much we pay for things when we are going shopping, and it's affected by inflation. As you can see in the chart, the CPI was at 9.1% in June of 2022 and dropped to 3% by June of 2023. This is yet another sign that the economy is getting better and inflation is starting to get under control. As it currently stands in July of 2023, all four indices look pretty strong, but things can change abruptly without notice, like we saw in 2020 with the pandemic. However, unless there is something major that happens, it looks like the United States economy will continue to get stronger as we go forward. Could there be a few bumps along the way? Sure. But I'm pretty confident in our country and its people to endure and prosper. I hope you found this breakdown informative. I know it was a lot. And if you agree with me, let me know below. And if you don't, keep it to yourself. No need to comment. Actually, in all seriousness, I'd love to hear your thoughts either way. And as always, if you have any real estate questions, I'm here for you. So just reach out to me. I've left a link below. I'm Scott, and you've been Real Estate Informed.